Hey, good afternoon, everybody. It's 12:01 p.m. now, right? We just crossed over the noon hour. We kind of timed this interestingly, I think. 12 at 12 gave us another reason for you to maybe remember we were going to do it. The CCEC certification is brand new from Annie Mac Home Mortgage. We run into residential real estate professionals all the time that are challenged with a buyer that's just 50 points off, or maybe faced a bankruptcy in the past, or had some sort of a judgment or problem in the past. Maybe they just carry too much debt, or they've had some serious challenges that they've faced. And what we do in our collaborations with our real estate referral partners is we always lead with education. We always want to forward the professionalism of the real estate industry through Fortune 500 caliber education. We do that with 61 different modules in the Annie Mac Nation. We've got 14 main instructors that we work with from across the country that help our realtor referral partners all over the place. We also do some other certifications. You may be familiar, maybe even be a graduate of our real estate staging certification. We are very, very proud, and we're relaunching our renovation real estate certification. That's all about fixer-uppers and handyman specials and how to take advantage of the new liberal lending rules in renovation lending. One of my favorites is the pet-friendly real estate agent. That is a very, very helpful course for realtors that want to serve pet lovers, and I'm very proud of the work that we're doing with Annie Mac Home Mortgage. So make sure you thank your loan officer. Make sure you thank your branch manager at Annie Mac. If there's value here today, or you've experienced or participated in value with us before, we are truly leading with education as an olive branch to the whole real estate community. We know that most of the teachers, trainers, and coaches out there are for-profit vendors that are charging you an arm and a leg a lot of times, and this is an opportunity for us to give back to the real estate community. So without further ado, I'm going to introduce a friend of mine named Paul Oster, is the CEO of FICO Pro. He's been referred to as the nation's credit repairman. He's a credit expert consultant for Fox Business News, CBS, and NBC. He's been featured in the Wall Street Journal, very, very active with the National Association of Credit Service Organizations. And I'll just tell you, I've been to some of his trainings in the past. He's all over the news. He's all over the radio. He's all over the brokerage industry, national circuit. And the opportunity is, hang on just one second. Somebody is trying to plug in as a presenter. I'm going to make Paul Oster the presenter right now. And this is the Consumer Credit Expert Certification by Annie Mac Works, hosted by CEO of FICO Pro, the nation's credit repairman, Paul Oster. Take it away, Paul.
So, obviously, a quick thank you to Russ Fitzpatrick, Annie Mac Works. Big shout out to Annie Mac Home Loans. You know, look, I do this all over the country, and, you know, there are other banks out there, but nobody seems to invest and commit as much time and dedication than the loan officers from Annie Mac. They simply go above and beyond for their agent partners and the consumers. So it's really become an awesome partnership, as all of you know, and that's the reason why you're here. So like Russ mentioned, I think it's awesome that this meeting is taking place across the country. Over, you know, hundreds of agents, top agents in the biz, some of the top, the best talent that's out there. So listen, welcome rockstar agents. Buckle up and enjoy this flight, because we're going to embark on a two module segment that's going to ultimately lead you to a consumer credit expert certification. And there's two 30-minute segments. In this first segment, we're going to touch base on all things credit reporting industry, the credit bureaus themselves. Who are they? What do they do? Credit scores, the FICO score, the FICO score, you know, what's on a credit report, and how all this really ties in to what we're trying to do as real estate professionals. So I'm excited for it. This is going to be great. Please ask your questions as we go through the presentation, okay? There's lots of you on here, so I'm not going to be able to answer as we go, but I want you to ask them as we go, because what I will do in the beginning of the second session, I will answer all the questions. I'm going to review the information that we go over today. And look, the second session is next week. Same bat time, same bat channel. Wednesday, December 19th at 12 p.m. We'll cover the second session. And that's where we're going to teach you how to use this certification as a marketing tool, how to use the certification to break down the doors in your local markets to become the go-to agent for everybody in the community, not just the folks with the 700 credit scores. Let's face it, they're the easiest ones to work with. This certification is going to tell everybody that you can work with everybody. All of the members in large unions and corporations and associations, that's what they want to hear. You can work with everybody. And if you can't help them today, you're going to be able to help them tomorrow. So both of the sessions are awesome for sure. The first one is more education based. The second one is where we're going to apply what we learn here today. Couple of things. These are the takeaways that we're going to get from today's session. You know, credit cards. Can credit card debt actually help your credit score, or is it always going to hurt your score? We're going to talk about the difference between secured credit cards and traditional credit cards. We're going to talk about, you know, do-it-yourself credit repair. And when is the time to actually try and look for and hire a legitimate credit repair vendor, because they are out there. You know, Russ mentioned NACSO. I am one of the early founders and members of the National Association of Credit Services Organizations. This is our own regulatory body. We built it ourselves because, believe it or not, credit repair is an unregulated industry. So we wanted to weed out the bad guys. We wanted to get rid of this dark cloud that's been hanging over an industry that, when done correctly, is so beneficial to the real estate professionals and their clients that it was about time that we got down to Washington, D.C. I've personally spoken at 2 government affairs conferences now, and we're just trying to educate and inform our legislators as to why credit repair is so important. How inquiries and new accounts affect your credit. Inquiries is probably the top question or comment I hear every time I speak in front of realtors. Everybody always raises their hands. What's the difference between a soft inquiry and a hard inquiry? And they've probably heard somewhere along the way from one of those silly commercials from a company like Credit Karma that inquiries are going to, you know, ruin your life and destroy your credit reports. You're going to be surprised when I really get into the impact of inquiries on the credit scores as to what you've probably heard, you know, on the television, let's say. Are there quick and easy ways to improve credit scores? Yes, we're going to get into that. Here's really where the rubber meets the road. How can realtors and mortgage bankers help the consumers get ready for home ownerships? There are some real do's and don'ts here that I'm sure a large percentage of the agents that are listening to this meeting right now have dealt with, both some of the good things and, unfortunately, lots of the bad things that can happen during the process of buying a home. And the 5 credit commandments that you must follow when buying a house. I am Paul Oster. I'm the president of Better Qualified. I am considered the nation's credit repairman at this point. And my mission is now going to become your mission. And our mission as consumer credit experts is always to shorten the distance from application to closing. You know, what we're trying to do is help the consumers maximize the benefits associated with higher credit scores. And look, during the home buying process, I get it. We're focused on the mortgage, but let's not forget your client also probably has auto financing. They probably have credit cards. They probably, or they're going to need insurance for sure. And all of those things are directly tied to the credit scores. So if we can do some things to help them improve their credit, we're doing things that are going to help them improve their entire life, not just buy a home. And that's another message that you're going to shout from the rooftops once you get this certification, okay? When you talk about being a consumer credit expert, you want the consumer to understand that there are some things that they can actually do on their own. But let's face it, when you're faced with the decision of hiring a professional to perform a service, can you represent yourself in a court of law? Of course you can. I would suggest hiring, the best attorney out there, depending upon, how much trouble you're in. Can you do your own taxes? You can, but you might screw it up. You might wind up owing more money. You might miss deductions. So there are times in our lives when that decision comes up that we should choose to find the best that there is out there, the best professional service to help us. And the biggest difference is really, the difference between price and value. And you will always get what you pay for, okay? When you talk about how you, a realtor, or any of the loan officers that are going, that are on this webinar here, when you talk about getting a consumer ready for home ownership, Russ mentioned it before, it's all about education and communication. And you want to do this as early as you possibly can. So, we're not trying to undo something that the consumer said, well, I didn't know I shouldn't do that. So the 5 credit commandments, and this might be a time where you write this stuff down. By the way, I will give all of you, access to all of this information at a later date. So if you take notes, that's great. If not, I will certainly send it to you. I have all my contact information, at the end of this. So here's my 5 credit commandments when you're talking about the window of purchasing a home. And I will start with the words, thou shalt not ignore your credit reports and your credit scores. If there was ever a time to be involved in a credit monitoring process, now's the time. And again, you get what you pay for. I hate to bash, other companies, but this is not the time to use a free service. And I will get into the Credit Karmas of the world a little bit down the road. But this might be a time that you spend, $10, $15 a month from a real robust credit monitoring service so you can keep an eye on those scores. Because, again, identity theft is and is going to continue to be the fastest growing crime in the country. And you don't want to get surprised with an account that pops up onto your credit report that might not be yours. And maybe you were a victim of identity theft. But at the end of the day, it makes it that much tougher for the bank and to go through underwriting, even if because you're going to have to prove that it wasn't yours. So check and monitor your credit reports on a regular basis during this process, okay? Thou shalt not use your credit cards excessively during this process. And what I mean by that is you cannot go over 30% of the balances to your credit limits, okay? Put the credit cards away during this time. Use your debit cards. Use cash to pay for everything. Thou shalt not open up any new accounts. And, I'll touch on it real quick here, but I would love to see a show of hands of how many times one of your clients, after a contract is put in on a home, they go out and they buy furniture. And I hear this from here to California, all over the country, day in, day out, that the client went and purchased furniture for every room in the house. And when they got to the checkout, the person simply said to them, do you have a Raymore Flanagan credit card? No, I don't. Well, would you like to save 20% on all of your purchases today? And the consumer says yes. And by opening that new account, They could have just lost their mortgage. They have beautiful new furniture that they have to set up in the park because they no longer have a home. Thou shalt not close any accounts. And we will talk about why this is so damaging when you open up a new account. And thou shalt not co-sign for anyone or anything during this process. Let's start off by talking about the big three reporting agencies, the credit bureaus. Their names are a misnomer. The whole thing is flawed at best, right? The credit bureaus are not government agencies. These are for-profit and publicly traded, privately held companies that do a terrible job at maintaining, obtaining, and ensuring the accuracy of the information that is going to really dictate so much of our lives. Let's face it, your credit score is going to cost or save you hundreds of dollars a month. If you go from excellent credit to poor credit, you could be paying hundreds of dollars a month more for all of the same things, whether it's a mortgage, insurance premiums, auto financing, student loans, credit cards. All of those things are directly tied to our credit score. So these big three repositories, they're nothing more than giant data companies that really have done the public an injustice. They haven't reinvested in their infrastructures. They've had, data breaches. They're always in the top three complaints to the FTC for like the past 20 years. Errors on credit reports are always in the top three. So is identity theft, and so are debt collectors. And we're going to touch base on all of these as we go through. But the most important thing for you to realize, the big three, Equifax, TransUnion, and Experian, these are not government agencies. These are just data companies that happen to be involved in the process of generating our credit scores. So here's the problem with credit scores. There are thousands, maybe more, thousands of scores out there. There are, 20 different FICO scores. So let's start with the FICO score. Unfortunately, there is a monopoly when you talk about credit scoring in this country and actually in the world. The FICO scoring model is used in about 95% of all underwriting in the world. And FICO stands for the Fair Isaac Corporation. Two very, very smart mathematicians at a Stanford University came up with a formula and an algorithm that could predict whether or not a consumer was going to default on a payment plan. That's what the scoring model says. It's not a good thing, it's a bad thing. It's going to predict whether or not we default on a 30-day payment or it's going to go into collections and never be repaid. Here's the problem. The FICO score is generated based upon information that is erroneous much of the time. I don't know what the actual percentages are. The FTC, the CFPB, they tell us about 25% of the time credit reports have false, inaccurate, erroneous information. I will tell you, 14 years later, 20 years in the banking industry, 14 years as the president of Better Qualified, tens of thousands of credit reports have been analyzed. And I would say it's in the 90 percentile. 90% of the time, there's information that is unverifiable, that is inaccurate, that is not timely, and it's causing the scores to be lower than what they actually should be. The average credit score right now, and again, we have to take all of this with a grain of salt because what is the scorecard that's being used? What is the model? It looks like about 695 was the average score last year. And that seems like a pretty good score. But the reality is that you need a 740 or above to be considered excellent credit. 740 or above. And it's not easy to have a 740 credit score. When you're talking about the people, the highest percentage of the population that are buying and selling homes, this segment between 30 and 39 years old of people, there's a high percentage of them that are below a 620. So as an agent, do you not want to work with that group of people? Because let me tell you, their money is green, their money will pay your bills, and it really increases your target audience. I'm not saying it's going to be easy, but what I'm saying is you can really expand the amount of people that you can work with once you become a consumer credit expert. Because sometimes it can take 30, 60, 90 days to get somebody from a 620 to a 700. So just think about that when we're talking about why we're going to target certain audiences, how we're going to use this as a marketing tool, and why this is going to help you crush 2019 with your new consumer credit expert certification. 28% of Americans are below a 620. And I use the Florida average there as a 629. It's one of the lower averages in the country. But let's face it, I know Russ is down there and a lot of the agents are down there. I don't have to ask you if the real estate market in Florida is on fire, because it is, and it has been for a while. So if you're in Florida or any state in the country, and the average credit score is a little bit below where it should be, that doesn't mean you turn a blind eye. That doesn't mean you walk away. That doesn't mean that, if the loan officer comes back and says, hey, we're going to have trouble closing this loan because, your client's at a 580, we're going to ask why they're at a 580. We're going to ask to look at the credit report. We're going to take a look to see what we can do to help the client improve their credit scores. Real quick, these are the credit score factors that go into the FICO score. Nobody knows the exact algorithm and formula, but they give us this big pie chart. And obviously, payment history is number one, right? 35% of the credit scoring formula weights payment history, okay? The problem here is most people don't understand how devastating a 30-day late payment can be. A 30-day late payment can cost you somewhere between 25 and 100 points. 25 and 100 points. So let's say you had somebody that was at a 700. A 30-day late payment can drop their score down to a 600. So we encourage everybody, put your bills on auto pay. I'd much rather get an overdraft fee from my bank than to get a 30-day late payment on my credit report. Amounts owed is 30% of the overall score. That also happens to be the magic number when you're talking about that utilization ratio that I spoke about with credit cards. You never want your credit card balances to be above 30% of your credit limits. If you have a couple of cards and the combined credit limits are $1,000, you never want your credit balances to be above 300. If they are, you have to focus on paying them down. Once you go over 30%, the scores will come down. Once you go over 50%, you're talking about dramatic impact on the scores. If you go over your credit limits by $1, let me repeat that. Going over your credit limit by $1, you could lose 100 points, especially if we're talking about our young borrowers that have thin credit profiles. Length of credit history. This is where we mentioned closing an account. For the average person, closing a credit card is the single worst thing you can do to your credit score. And here's why. The accounts have to be open and active in order to be counted towards your credit history. So if you close a credit card, let's say you get angry with Citibank or Discover, whoever it may be, and you pay the card off and you close it. Well, you just did two things. You lost whatever available credit you had on that credit card, the amounts owed, the utilization ratio right above this, and you just lost the credit history. So you just had a negative impact on 45% of the scoring model. So before anyone closes a credit card, they really need to review their credit reports and their credit histories. New credit, 10% of the overall scores. Look, inquiries, 10. There is a risk that the scores are going to drop. They also give us a window of time to shop around. I use the 14-day rule because sometimes it's 45 days, but sometimes it's 14 days. And the problem with that is you will not know what scoring model is being used until you actually apply for the loan. So use a 14-day window to shop around. Any mortgage inquiries in a 14-day window will be readjusted to one inquiry. Any inquiry in the auto industry will be readjusted to one. Any credit card inquiry in a 14-day window will be readjusted to one. So they have given us the ability to shop around. You just need to be really careful with how many times people pull your credit. And especially during the window of purchasing a home, this is what tends to happen. The client goes out, and obviously there was a mortgage industry because they're pre-approved. Now the client goes out and they want to get a Home Depot card. Maybe they want to buy a new car to go in their new neighborhood. Maybe they do open up that Raymore Flanagan card. Maybe they get a Home Depot, Bed Bath & Beyond. Those mixed use inquiries, that's when it can become pretty devastating to the credit scores. And remember, let's say it's only 5 points, or let's say it's only 3 points. A 677 is not a 680. So if the loan officer over at Annie Mac had us approved for a certain program and interest rates at a 680, and when we get to the closing table, it's a 677, we could have some issues there. So they need to be aware of the inquiries. They need to be aware of opening new credit accounts. When you open a new account, there is always a tendency for about 6 months for the scores to come down. It takes 6 months to season the account in the eyes of FICO. So during that 6-month period, the scores have a tendency to come down on top of the points that you may have lost for the inquiry itself. Types of credit, there's really only two: revolving lines of credit and installment contracts. Installment contracts are your mortgages, auto financing, student loans. Revolving, your credit cards and your department store cards. Remember, folks, any questions you have, ask them while we're going through the presentation so you don't forget, and I will answer all of them at the beginning of the next session. What's in a credit report? You need to identify these 5 areas. You need to find them to make sure that the information is accurate and what you're looking at. So the first one is pretty easy: identifying information. That's your name, address, social security number, dates of birth, previous employment history. That's all used to identify who you are. And you have to make sure that it's 100% accurate. You have to make sure there are no red flags for identity theft. When you look at also known as AKAs, and you look at addresses, if the borrower does not understand that information, it could be a red flag for identity theft. Trade lines. This is the actual account information. What's the name of the creditor? How long has it been open? What's the principal balance? What was the original balance? What's the status? Is it in collections? Has there been any late payments? Inquiries, we spoke about it. Find them, find out how many there are, take a look, and make sure that we're not getting too crazy when it comes to how many inquiries are on the reports. Inquiries will stay on the report for 2 years. The inquiries from the previous 12 months are the ones that are going to affect us the most. Collections. Sometimes there's a separate section for collections. Sometimes they're mixed in with the actual trade lines. So you need to find out what the status of each trade line is, and you need to see if there's a separate section for collections. I specifically talk about collections. A lot of times a mistake is made in the real estate industry. Realtors and loan officers might tell somebody thinking about buying a home, Hey, listen, Bob, you got to go ahead and pay off all those collections so we can get you approved. Paying off a collection that's more than 2 years old can actually hurt the borrower's credit score. So what should happen is we should put those collections through a verification and validation of debt process, and I'll talk about that a little later. The next section, public records. You have to find this section. Don't assume if you don't see any public records that they're not there. The public record section is either going to list the public records or it's going to say there are no public records. But you need to make sure you find that area so you can identify whether or not there are any public records on the credit report. Talking about public records. Something happened July 1st in our industry that was awesome. You know, and not a lot of awesome things happen in the credit repair industry or credit reporting industry. It's the National Consumer Assistance Plan. Tremendous pressure from the CFPB, some state attorney generals. They put the pressure on these credit bureaus because what they found is matters of public record. Experian came out and said their own data, 96% of the information was unverifiable. It was incomplete and inaccurate, specifically for civil judgments and tax liens. So after July 1st, the bureaus agreed, we're just not going to report that information anymore. Now, that's what they told us. I will bet you, dollars to donuts that millions of credit reports still have judgments and tax liens on there, but they don't belong there. And that's one of the easiest things now that a consumer can do for themselves is get that information taken off of the report. Who wins? Obviously, the consumer wins here. It was estimated about 12 million Americans saw a jump in their credit score, anywhere from 10 to 40 points. So what are lenders looking for today? We talked about the scores. We're going to talk about housing and payment histories and how you can verify them, what late payments do to credit scores. We're going to talk about foreclosures, short sales, modifications, bankruptcies, charge-offs, collections, disputed accounts, public records. This is a big part of the process, and I don't have to tell the loan officers that are on the webinar here, this is where things get crazy. People pay in cash. They pay all sorts of different ways. They have their cousin make the payment. If it's not being reported on the credit report, you have to make sure there's a record of canceled checks. You have to make sure there's a record of money order receipts. You have to be able to show bank statements reflecting consistent withdrawals that are being used to make those payments. In the best case scenario, there's a management company that can verify the rental payments for the history that the person has been there. Foreclosures. Again, programs change all the time. Guidelines change all the time. This is an area when you want to make sure you go to the professionals at Annie Mac Home Loans and find out what can be done for somebody who had a foreclosure. Were there extenuating circumstances? Why did the person go into foreclosure in the first place? Unfortunately, you're really looking at a 3 to 7 year period, depending upon if you're going to go conventional or FHA. Short sales. Most of the damage for short sales is done before the short sale, right? They've had numerous mortgage lates going into it. Maybe they've had late payments on credit cards and auto payments. The short sale itself is like a collection account, so it's not that damaging. The guidelines, somewhere between 2 and 4 years. Modifications. Boy, they were a hot button topic there for a while. There were some very good companies out there, and there were some very bad fraudulent companies out there. But people were able to modify their mortgages, okay? And again, just like the short sale, the modification itself usually doesn't disqualify the borrower. It's what happened to the mortgage history before the modification. Usually, the bank is going to need 1 year of clean mortgage history. Bankruptcies. whether they're Chapter 7s or Chapter 13s. If they're Chapter 7, all of the debt has been wiped out, you're looking at 2 to 4 years. If you're looking at a Chapter 13, the buyer can actually get permission from the trustee in the court to get approved for a mortgage sometimes while they're still in the Chapter 13. But really, you're looking at a 1 to 4 year period, depending upon the circumstances and depending upon whether it's going to be conventional or FHA. Disputed accounts, if they go through a credit repair process or they try and do it themselves, you have to remove the disputed status from the accounts before you get to the bank, because it's going to screw up DU underwriting. You don't want to have to manually underwrite the loan. It makes it a little tougher. It just causes problems. The bureaus actually have some hotlines. I can give everybody all of this information. You make one phone call to each bureau and you can have the disputed statuses taken off the accounts almost immediately. This is a consumer credit expert certification, but I just wanted to touch base 20 seconds on business credit. For the agents that own their own corporations, it is imperative that you build, manage, and monitor your business credit. It should stand alone with no personal guarantees. For things like automobiles, gas cards, credit cards, office furniture, and equipment can all be built under your corporation's credit with no personal guarantees. So it doesn't matter if you've had some personal credit issues in the past, you can actually build your business credit profile faster than you can build your personal credit profile. Student loans, this is one of the worst things that's happened, for sure in this country. It continues to grow by the trillions. Here's the thing about student loans. You have to assume if the parent is going to co-sign for the student loan, they should make the payment to the student loan, to the creditor, and little Susie or Johnny pays them. Because if they're not going to make it the payment anyway, the parent needs to know about it before it's too late. We see this all the time. People come to us, they're looking to downsize. They think they have perfect credit. They don't use credit monitoring. They pull their credit report and they have collections from student loans because little Susie and little Johnny defaulted on their student loans. So if you're going to co-sign, you need to control the payment history on that account. If you're not going to monitor it with a fine-tooth comb every single month to make sure it's paid, you make the payments and whoever you co-sign for is going to pay you. Also, this will affect your debt to income. The bank, it's like you are obligated to make 100% of the payment because there have been so many defaults. So really do not co-sign for anybody, especially after you started the process. But if you have co-signed, please realize that you are obligated for 100% of the debt. We're getting close to the end here, and hopefully you've already become a better agent, and we're just going to continue down that path. Beginning of the next session, we're going to talk about the exam. Don't get nervous. I have 100% pass ratio. What are you going to do with that certification? I'm going to give you all the scripts, all of the marketing, and the action plan, right? Because knowledge is not power. Applied knowledge is power. So we've got a pretty good base working for consumer credit right now, and we're just going to build on it next Wednesday. Here are some of the exam questions. I don't want to go through them right now. We're running out of time. Again, I'm going to go over all of this stuff with you so you don't have to worry about anything. I love this slide. I put it up every single time I speak, and this is really where we're going to talk about next Wednesday. You can't just buy the treadmill. You can't just get the certification. We have to figure out what we need to do on that treadmill. And again, I can't wait for next week because that's where I really get excited. And we're going to talk about how you're going to use this certification to actually grow your business in 2019. We're going to talk about niche markets. We're going to talk about using emotional storytelling. There is nothing more emotional than helping a family who had, poor credit or no credit, and you got them into their first home, that is a lifetime client. That is not just a lifetime client. That is a lifetime client that's going to refer you to the other family, other friends, and coworkers. We're going to talk about why you should host a webinar. I'm Paul Oster. I'm a certified FICO pro. That's my email address. That's my cell phone number. So if you have any questions, you want to follow up with me offline, you can contact me directly. That's our website, betterqualified.com. And here's the bottom line, right? I'm hoping that you join today's meeting to make more money. I hope you join today's meeting so you could grow a knowledge base that's going to help you. You're going to become the go-to agent with an expertise in consumer credit. And you want to be able to tell everybody, again, I can work with everybody. I'm going to help the buyers, the sellers, the renters, and the dreamers. I want to thank everybody. I know your time is valuable. Thank you for being here today with me. Thank you, thank you, thank you. I'll see you next week. Same bat time, same bat channel. December 19th at 12 o'clock. We're going to finish this certification, and we're going to talk about how you're going to crush 2019.